Hello, my name is Chris Beaumont. I'm one of the partners at Clive Owen. I'm here today with my colleague.
I'm Kevin Shotton, again a partner at Clive Owen.
And we're going to be talking about the Kreston UK Academies Benchmarking Report 2024. I'm going to do a little bit of an intro into the sector, then have a look at sort of reserves, and then Kevin's going to go through sort of income and expenditure. I'll then look at balance sheet transactions before then sort of moving on to sort of some of the quirky things that we've got which otherwise don't feature within the report. So what is the Academies Benchmarking Report? It's a review of the financial health of the sector. This year the number of trusts that are involved are, as you can see, sort of nearly 300 trusts and some 2,300 schools. That's a similar number to what it was last year. And when you look at that and compared to the population of the number of trusts and schools, what you can see is it represents about 12 or 22% of the population of trusts or schools as at the 31st of August 23. So it's a fairly good sample of the sector. As with last year, we've included some non-Kreston clients, and that's really to sort of give us some more data for the larger trusts, so we've got a better sample size there for comparison purposes. And then we've split the multi-academy trusts into three. Those below 3,000 pupils, and that really reflects the school conditional allocation and the fact that schools above 3,000 pupils and 5 schools are able to get that, whereas those below are still on the SIF allocation. The 7,500 is for those sort of larger or stronger, to use the word in the white paper from a few years ago, those larger sort of trusts. So what's happened with the sector over the last few years? What you can see on here is that the number of schools has increased by about sort of 1,500 over that period of time. If you go back the previous 5 years, you'd actually see the expansion of the sector being rather more rapid. And at the same time, I don't think this will come as a surprise to many people listening today, but the number of standalone academy trusts has reduced from sort of 1,546 down to 1,222. So a reduction of about 320 or so standalone academy trusts. And that's because a lot of those standalone academy trusts have been moving into the multi-academy trusts. And Kevin and I have a number which have moved across in sort of either December, January of this year. So we expect that number to reduce yet further. And also reflected within that sort of consolidation of the sector is, whilst, as I say, the number of schools has increased by some sort of 1,500, the number of trusts was 1,175 back in 2019. It's now 1,182, and that sort of really reflects the sort of the growth that's happened within those trusts. And what you can see here is the number of the average number of schools in a multi-academy trust within our report, and that's increased from 7.5 to 10.5 between 21 and 2023. That sort of mirrors the sort of the growth in the national sector, whereby for 2022 the average across all academies is about 7.3, an increase to about 7.7 over the last year. So moving on and looking at sort of the free reserves. When we're talking about sort of free reserves, what we're talking about here is unrestricted monies, designated monies, and things like the general annual grant balances which are being carried forward. And what we're doing here is comparing carry forward balances from last year to what we're carrying forward this year and saying, well, that roughly equates to the surplus or deficit in the year. What we can see here is for primary standalone academy trusts, they had sort of deficits for the last couple of years of around about sort of £40,000. Similar year on year, probably because they actually haven't got much room to manoeuvre. Their cost base is reasonably static, and therefore that's what we're seeing there, is a reasonably sort of consistent sort of loss, but it is a loss, and therefore again that's one of the reasons why the standalone academy trusts are moving into the multi-academy trusts, is that financial security they're looking for. But what we can see on the other side, and Kevin will go to some bit more detail with income and expenditure, is whereas there was some fairly healthy surpluses in 2022, I mean as much as £1.5 million for the larger sort of multi-academy trusts, that's now reduced to sort of 267,000. So we've actually got a reduction in the surpluses that are being achieved of between sort of 83 and 95%. So pretty consistent across those four types. And as I say, Kevin will go through it in a bit more detail in a minute, but really sort of around the income and expenditure and what's happening there within those trusts. And what I should say is those are averages, because the other thing that really sort of came out of the report this year was, whereas a couple of years ago 19% of trusts had an in-year deficit, that number has now increased to some sort of 47% of trusts having an in-year deficit. So significant number of trusts now sort of facing sort of financial challenges. Sometimes they are sort of self-imposed because actually they realise that actually their reserves are possibly too big, or they've got some sort of policy to want to invest in sort of fixed assets. But sometimes it's also, I say, the challenges which these organisations are finding. And as you can see here, the average free reserves are fairly substantial. You've got £300,000 plus at a primary stat. The larger sort of multi-academy trusts, you're talking about sort of £7 or £8 million. So some sort of fairly sort of sizable sort of balances there. But going back to what I was just saying about the deficits, National Audit Office sort of 18 months or so ago came out and was saying to the ESFA that they should be challenging those trusts where reserves were above sort of 20%. And during the latter part of last year, the ESFA did come out with their own paper on reserves. Actually, it was a good paper, so if you want to read upon something else, have a look at the reserves paper that the ESFA have released. But that also sort of said whereby reserves were more than 20%, they would be asking questions. It also highlighted in there, which wasn't in the National Audit Office report, the fact that where reserves were less than 5% of income, there would be questions as well being asked of those trusts to see whether they were financially viable. One of the sort of slight challenges there for trusts is what is income, and does sort of transfer of a school in, does capital money represent income when you're comparing reserves against income? And as far as reserves are concerned, what are reserves? In some cases you might think that designated reserves should be included, others will think otherwise. So it's not as clear as it was, but what you can see is there is some sort of increases going on there, which reflect what I was saying in the previous page, but very marginal increases. But then the larger sort of multi-academy trusts are down. But I think in the large cases that was actually planned, A, because the National Audit Office was putting out this guidance, but B, also because of investment in infrastructure. And Kevin and I have both got clients which have been spending anything up to sort of £5 million this year on sort of a planned sort of expansion of the or renewal of the estate. So on that note, I'll pass across to Kevin to look at income and expenditure.
Thanks, Chris. As Chris said, I'll just go through some of the key trends and things that we're seeing when we break down into the income and expenditure side of things. Start off on income. So just looking initially at total revenue per pupil. If you look across the categories there, you can see that there is an increase across the board. The average increase is about 8.6% year on year in terms of that total income. That's there's been some big drivers within there. So in terms of the MSAG monies that start being received from 1st of April this year, and it's also the first year there has been a full year's worth of the supplementary grant as well, which started in the year earlier. So headline numbers, income looks strong, but as we'll see as I talk further through, actually 8.6%, is that enough given the general inflationary factors that have been seen across the sector? So then just looking at the GAG income per pupil, quite an interesting one. This is obviously GAG is the core funding that comes through, but there have been some shifts in that funding over the last 12 months in terms of previous teachers' pay and pension grants that have been amalgamated into that grant, but also some of the sixth form funding is now reported differently within the accounts in other DFE. So actually it's quite hard to read anything, because you see in particular secondary SATs that you can see there's a drop there on average, but that is probably due to the sixth form funding coming out of that, and therefore actually it's probably easier to to look at that overall income graph that I started with, as opposed to looking at the GAG income this year. Certainly when we look at total income received from the ESFA, DFE, actually the percentage increases are more in line with that 8.6% that I mentioned on the previous slide. One thing just to pick up on ESFA funding is just around pupil premium and some of the challenges that are still being experienced in terms of making sure that schools are capturing all of the pupil premium, particularly in primary schools where you have the infant free school meals, which may mean there's less of an incentive for parents initially to sign their kids on for that. Interestingly, there's 2 local authorities that have actually changed the way they are doing that, whereby they're taking the details from benefit information and parents have to actually opt out. Now I suppose the question is that the way forward, and will it lead to fairer funding if other local authorities adopt that as well? So now just turn attention to the COVID funding. So this is largely made up of the recovery premium and the tutoring programme monies. In particular, if you think about the tutoring monies, there is a clawback on that if it's not spent, and looking at the 21-22 year, over 1/3 of that income was actually clawed back. And you can see this year that it appears that there's significantly more funding, but we suspect that the clawback is playing into that, because as trusts and schools have a better idea and are able to plan for how to spend that money, more of that income will be recognised alongside the cost, whereas if the money was being clawed back, it wouldn't be recognised within income. So a chunk of last year's income going back probably means it was never reported as income in the first place. And then capital income per pupil. So this includes devolved formula capital that all schools receive, and then you're looking at the SIF income or the SCAR income. Now SCAR income obviously is only applicable to the larger trusts within this, and SIF obviously can be quite lumpy. So when you're looking at some of the spikes on these graphs, particularly at primary SATs, where we're seeing a huge dip, that is most likely due to the timing of successful award of SIF bids in the year. So again, these graphs can be quite heavily distorted depending on the nature of the clients and their success at bidding into some of these pots. Certainly when you start to look at the bigger mats towards this end, you can see there's a more steady increase there, and one of the reasons for that will be the additional pot of energy efficiency monies that were received by all trusts in or all schools this year. We then move on to the cost side. So interesting, starting with some graphs that are looking at the percentage of staffing or the staffing costs as a percentage of total costs. And if you look at that in isolation, it actually looks like quite a positive picture, because actually you're seeing that percentage dropping down. However, I think the unfortunate reality of that is that we have relatively large increases in staffing costs. They just happen to be dwarfed by even larger increases in other costs. And we'll see that as I move through in terms of the impact of other costs on the cost base within the academy sector. And then just looking a bit closer at salary costs, obviously it still remains heavily the largest costs within the sector, as the previous table showed. What you can see here is there's a bit of a mixed bag across trusts in terms of where we're seeing increases. In some we're seeing reductions of that average. We think the reason for this actually is to do with people joining and leaving the profession. So when you look at the number of leavers and joiners since 2021, people or teachers are leaving at a much higher rate than new teachers are joining the profession, and particularly in those older age groups, the 50 to 59 or the over 60 age group. So what we're seeing is some of those more experienced and generally more expensive teachers dropping out and being replaced with people at the lower end, which in individual trusts can quite heavily distort those averages. And then just looking at supply costs, so obviously by their nature, supply costs quite often aren't planned, and you know, again, general data is telling us that, you know, in the wider economy, but also within schools, there is more and more sickness year on year, and therefore how you plan for that is quite important. Arguably, that can be easier to do, or it can be done more cost effectively in your larger MATs, where they could in effect employ their own supply teachers to cover any illness. It's much more difficult to do in primary and secondary SATs, where, as Chris has already mentioned, reserves are already tight, budgets are tight. To have a floating resource is quite difficult to justify in there. And actually, when you look at the tables or the graphs here, you can see that the supply costs per pupil have actually dropped in the SAT side, and I suppose the question is that because of budgetary pressures, that actually where there is illness, cover is being done by another means instead of bringing external supply in. And then when we start to look at the MAT level, yes, we're seeing increases there, but the increases aren't hugely distorted, and actually the larger the MAT, it appears the lower the percentage increase that we're seeing as well, which again moves back to my earlier point in terms of whether the larger MATs have their own kind of internal resource there that they're utilising to cover sickness. And then non-staff costs per pupil. So I mentioned earlier when I looked at the first table on costs that non-staff costs are growing at quite a rapid rate. It's quite interesting actually when you look at the 2023 data, the level of consistency there that you can see across the different categories of trusts, where actually the average non-staff cost per pupil are within really 10% in the highest cost base to the kind of lowest cost data that we've got there. And the percentage increases are ranging between 13 and 16%. So tying back to what I mentioned earlier, that is, you know, significantly above that average income increase of 8.6%, and also relative to the pay awards that have come through that obviously have, you know, been painful from a financial perspective. Again, they haven't been at that sort of percentage level, which is why in that earlier graph we're seeing the percentage of staffing costs dropping as a proportion of overall costs. And then one of the main drivers of that is when we get to heat and light costs per pupil. Probably won't surprise anyone. We started to see the impacts of this last year, although there was some protection last year where schools were still in their fixed rate deals. More and more of those have started to come off in the current year. And if you're looking at the categories there, the lowest percentage increase is actually 49%, which is, you know, quite a staggering increase, particularly when you consider that the energy bill relief scheme was still in place until March 23, which, you know, pretty much covered half of the year. I guess the worry on this is what's to come. So whilst we are starting to see some stabilisation and some dropping of wholesale prices, a number of fixed deals were coming to an end partway through last year, and therefore this may not be a full year impact of the cost that we're seeing on this graph. And on that point, I will pass you back to Chris to run through some of the other headline areas within the report.
Thanks very much for that, Kevin. And it is sort of very noticeable. I mean, Kevin picked up on there on a couple of the grants that were coming through this year, which a full year for one of them this year and a new one. I mean, for a secondary school, that was sort of typically a couple £100,000 worth of additional income. If you take that out of the equation, then actually a lot of the trusts whereby they were making those small surpluses would have been in deficit without that additional money coming through. What I thought I'd touch upon here is sort of really a bit about sort of what's happening within the sector around sort of pooling of reserves, and it's not something we've probably seen that much happening within the North East and North Yorkshire at the moment. But what you can see here is the number of trusts which are either pooling sort of the GAG or reserves, because some trusts decide they're going to use different levers for this. The percentage of trusts now which are doing it is fairly significant. I mean, now up to sort of over 40% of the larger multi-academy trusts are doing it, and even more sort of the medium ones, you've got 40%. And this for some is another way of actually looking at the sort of the top slicing, and rather than doing a top slice, and I'll come back to that in a minute, what they're doing is actually saying we're actually going to pull reserves, pull the GAG, and therefore we don't have to do that top slicing, and we can therefore use the resources we've got within the organisation for the individual schools as we see applicable, rather than saying we've got £3 million GAG coming in for this school, therefore that's what we're going to spend. It can be in certain instances, actually we know we're going to get £3 million of GAG coming in, but because we're pooling it with everybody else, we might spend 3.1, we might spend £2.9 million within that school. So it is something that's a growing trend. I think it will continue, and we're getting a lot more inquiries from our sort of clients in respect of this. I think more sort of trying to go down the reserves rather than the GAG pooling is my personal experience, but we'll see how this one sort of pans out going forward. So I mentioned sort of the top slicing as an alternative, and historically we've probably sort of seen sort of 5% as being a sort of a magic number which most people have sort of referred to. I think that's changed over the last year or so, and actually people are now actually increasing that sort of 5%, and I'm hearing more trusts talking about 6 or 7% being applicable to cover those sort of central costs. So when we're looking at central costs, I'm talking about sort of the finance, the HR, the ICT, possibly a sort of school improvement team in there as well. And what you can see here is you've got sort of 7.4% is the average at the sort of those smaller trusts, giving up to sort of, or coming down rather, to sort of 5.4% by the time you get to the sort of the larger multi-academy trusts. And that really is because that central function is going to cost you a certain amount to set up. If you then add on a few extra schools, the incremental increase is not going to be that significant for you. So sort of moving on to sort of the balance sheet, and just a reminder, right at the beginning I talked about reserves. These are cash balances, so the two things are significantly different. It can be between 150 and 175% more cash balance than reserves balance, just because of the way that PAYE payments are due, local government pension scheme, teachers pension scheme, but also things like unspent fixed asset monies at the year end distort the ratio there. But what we've found with a number of trusts this year is they've very much looked at their treasury management policy, and they've actually got those policies signed off by the board, so looking at sort of what type of organisations putting the monies with, what terms they should be putting on, who can sign off on what, making sure they don't get caught out with things like, well, some of the listeners will remember things like the Icelandic banking crisis of a few years ago, making sure therefore that they've got money appropriately spread, so they don't get caught with anything like that. But what we're seeing is, with interest rates of sort of 4 or 5% being available to Academy Trusts, if you've got £1 million on deposit, that's suddenly generating you £40,000-50,000 worth of income, which, given what Kevin was talking about a minute ago about the cost pressures, is actually very usable and very tangible for the trusts. And when you've got some trusts now looking at sort of putting on sort of £10 million onto some sort of deposits over a range of sort of organisations, you can suddenly talk about £400,000-500,000 worth of additional income, which is going to be of significant benefit to a lot of trusts out there. Some trusts are put off opening new bank accounts because of the sort of the money laundering regulations and everything else out there, because sometimes it's not the easiest thing to go and open another bank account, given the regulations that need to be gone through. But there are a few trusts now looking at sort of various platforms. Flagstone's one that a few of our clients use. There are others available to you, and with those, what you do is you sort of really reflecting the treasury management policy, you go on and actually sort of say what type of bank you'd like to put the money on with, how much you'd like to put on for what term, what the maximum exposure is to any one bank, and that platform will then come back with a recommendation about how you should actually spread that money, and they will do all the money laundering procedures for you. So it takes out that sort of hassle factor. And when the money's come back in, they'll then come back to you with a recommendation. One thing you've got to remember is obviously there'll be a cost associated with things like those platforms. So what you're going to make sure is the extra interest you're actually going to earn obviously offsets those additional costs that you have coming through. And then estate management costs. We've looked at it this way this year because with some of the grants monies that are available, some of the expenditure has been going through the SOFA, income and expenditure account, some of it's been getting capitalised on the balance sheet, and therefore trying to sort of try and compare like with like has not been the easiest over the 2 years. But I mean, it just gives you an idea here now of the average estate management cost per pupil. And it's obviously, there's more spend at the Malta Academy Trust, but as I mentioned, some of those have got some very established now estates policies, and they're actually implementing those with some very significant monies behind them. The other thing is, when we sort of look at some of the reports that are coming out from the government, there is a problem with the school estates nationally, and that's going to take some very significant investment, and there's numbers and everything else which are reported or we refer to within our report about how much money is going to need to be spent on the estate across the forthcoming years, and RAC has only sort of exacerbated that situation. And the other thing we sort of thought we put in, it's actually the first time we've actually had the data to actually do this in sort of with some sort of meaningful comparisons, is there is within the expenditure which our trusts are making, there is actually obviously a sort of a wish to become more sort of environmentally friendly and try and reduce CO2 emissions. And what you can see here is that's a sort of matrix there showing you sort of different size of trusts and the CO2 emissions out there. But down at the bottom we've actually got the average CO2 emissions per school. So it has come down over the last couple of years. What I would say is there is an awful lot more work to be done if we're going to get to net zero, which is going to involve a significant amount more investment. So it's going to be interesting to see how the government actually tries to address that and what additional monies may come to schools to help them with that. And then pension deficits. These are deficits because there's a few of you will have discussions with us about assets and the fact we've had to do secondary calculations to make sure whether we're recognising the asset or not. So these really sort of reflecting the liabilities. And what's happened over the last couple of years is the assumptions behind these have meant that the liabilities which have been reflected on your balance sheets have actually reduced fairly significantly. And as you can see now, I mean, we're down to sort of £300 per pupil, or less in a lot of cases. So significant reductions from where we were a number of years ago. But it is I've got to be careful what I say here, but effectively it's a paper number. It's not something whereby you suddenly have to make this payment good within a sort of year or two. It's something that'll be paid over a number of years, most likely sort of 20 plus. Which leads me on to the employer contribution rates, and as most of you will be aware, the employer contribution rate changed on the 1st of April for the local government pension scheme. And interestingly, although we've actually not seen much change within sort of the North East and North Yorkshire in sort of the rates that our clients are paying, nationally you can see there's another sort of 18.8% rather than 16.7% are now paying more than 22.6% as an employer contribution. Just a word of warning about that chart there, but it'll probably reflect in the 23 and the 22 numbers, is that where a pension scheme is in deficit, sometimes the deficit payments are made as a separate payment, sometimes they're included in the employer rate. So just one of those things just to be mindful of when comparing, but it does show at the top end a fairly significant sort of increase, which, bearing in mind those sort of numbers, or those that cost is not reimbursed by the government, is something that those trusts will have as a fairly significant issue for them. Other information in the report, sort of really that's sort of what we're covering off there. So we haven't talked today, Kevin and I, about sort of governance or sort of internal audit and risk management, but there's pieces on all of those. There's your usual sort of tables as well, and things like the Chief Financial Officer's salaries and the Chief Executive Officer's salaries are actually included in there. We haven't put them up today, but they're in the report if people wanted to sort of download them. And where does this take us looking forward? I think there's probably more uncertainty at the moment than I've probably seen in a while when talking to trusts. There's a general election just around the corner, sometime later this year, possibly early next year, but only January of next year. And what's that going to mean? What's the sort of the policies from the two big parties? As far as the Conservatives are concerned, they obviously have the white paper, but that's really been sort of dropped. As far as Labour are concerned, we're seeing a sort of, we're going to allow academies to continue, but we'll have the maintained sector, and we'll have the two running in parallel with each other. So there's a little bit of uncertainty there about sort of direction of travel around what's going to happen within the sector, but also sort of obviously sort of funding, and that's no different to, in some respects, previous years. Although this year, which party's in will give significantly more sort of issues around that. But as we've said in previous reports, it would help when effectively the government is asking our academy clients to actually do 3-year forecasts, if the government actually supplied them with some idea about what the gag monies were going to be for the next 3 years. At the moment, they're working blind. In fact, they've got the first year numbers confirmed, but they're having to make guesstimates about years 2 and 3. And similarly on the sort of salary increases, because effectively there's no sort of forward planning for the next sort of 3 years. Sometimes when the 3-year forecasts are done, actually there's no actual knowledge of actually even what the pay award is going to be in sort of September coming, which when you're doing these forecasts and everything else in May, means that you can start the year with a budget forecast which is very much almost wrong, in inverted commas, from day one. Other major problem for sort of organisations going forward is the sort of the teachers' pension scheme, and the increase there from the 1st of April, so that's going up yet again. You'll remember I was talking previously about this used to being 16.48% a couple of years ago. Well, sort of now we're looking at 28.6%. That's a sort of neck end of a nearly over 75% increase in a 5-year period. So it is very, very significant, and with more and more independent schools leaving the scheme, it is like there's going to be more pressure on that for basically the contribution rate to increase yet again. At the moment, we've got from the government a sort of guarantee for the first year, but again we'll wait and see what that happens in due course. And then we all sort of have seen the sort of the falling birth rate and the numbers which are produced by the ONS there, and again that's referred to within the early parts of the report. But so obviously the bulge which was coming to the primary schools has now left the primary schools and is now in the secondary schools. And what that's giving is a sort of a challenge to those primary schools around how do they go out and market to try and make sure they're either full, or how do they just sort of restructure internally to make sure that they're actually fit for purpose going forward, and that they're not overstaffed or having excess rooms which they no longer need. And that sort of really sort of feeds into the last one on there, which is the school estates. And as I mentioned earlier, there needs to be some fairly significant investment in the school estates over the next few years if they're going to continue to be fit for purpose. So if you'd like a copy of the report, the contact details are on your screen there. Please just sort of either download a digital copy, or if you email our marketing department, they'll get a hard copy out to you as well in the post. And then finally, thank you very much on behalf of Kevin and I for listening today.